Steve, I was just ruminating about things the other day, and it seems to me that there are just so many options in the world, of things to do, people to see.
Yeah, so if you're unlike us, or maybe you're like Steve, and are curious about stock options,
Oh, yeah.
this is the video. So we're going to talk about how people are able to make money when the market goes up, when the market goes down, and when they go sideways. So if you're curious about that, this is the video you want to watch.
Options call.
You found the Steve and Steve Show.
I'm Steve Wastenberg.
And I'm Steve Walsh.
Hey, Steve.
Hey, Steve.
We usually start with "Hey, Steve" or "Hello,
I know,
Steve."
I thought I'd throw a...
I like that. Yeah, good little.
You know the other thing we forgot?
What's that?
Drinks.
Oh, shoot. Hey, you know what? I kind of see some water over here. Want to drink some water?
Maybe we have some water that we
Have not had in any show prior to this or anything.
That's right.
So,
if you're just hitting our show, thank you for watching and finding us. We hope you will enjoy this one. Not sure what the topic is just yet, but make sure you hit that subscribe button.
and like.
And hit the bell so you get notifications. And don't forget to share and add comments.
Graham Stevens, Graham Stevens is the real estate guy. I like his YouTube channel. He always talks about smash that like, and so smash the like.
He talks really fast.
He does talk very fast.
And I
we,
think
on the other hand, speak with an orotund.
And he does a lot of cutting.
He does, and we're raw.
Yeah, we do
just
very little
stream of consciousness kind
mainly
of stuff.
because we just don't have the skills or the time to edit the videos.
And you know what? I mean, our audience, massive that it is, likes it this way.
Yeah.
Over a year, Steve. We've done it over a year.
Yeah.
We'll have to stop saying that in the next few videos, but
by the time this one gets aired, it'll be February.
that's right.
So actually, Steve, we do actually have a topic.
We have a topic.
Just kind of rambling.
We've got a lot of options.
I think that is our topic, is options.
Options. Oh, you mean options like trading options.
Stock trading options.
Because we've talked about stock trading, right? And you and I both love to trade in the stock market.
Yep.
Right?
So you know how, and I don't know if people have studied other gurus, but a lot of gurus out there, financial gurus, they say that no matter what the market is doing, either it could be going up, it could be tanking, going down, or it could go sideways. But they all say that they can make money off the stock market with any of those situations.
Yep, they do. And the way they do it is, honestly, one of the ways they do it is with options.
That's right.
Which are considered derivatives, right? They're considered derivatives because they are a derivative of the underlying asset. And the underlying asset in this case is the stock.
Right.
The share. So
right.
Tesla. I own one share of Tesla. If I want to get an option on it, I can get a contract on 100 shares of that Tesla.
Right.
But,
yeah,
Steve,
I think we've done a show on the contracts and stuff like that.
We have.
But we can do a quick thing. So when you have an option on stock, and you use Tesla, it is one contract to control 100 shares of Tesla.
That's right.
And sometimes you're controlling that contract. You're basically putting a bet out there that the value of Tesla is either go up or it's going to go down.
Right. So if it goes up, what's that called in option language?
So if I'm expecting it to go up, right, then I will put a call option.
You will put a call option. Right?
I will buy a call option.
All right.
So
you'll buy a call option.
Yes.
And that then gives you the right to 100 shares of Tesla at a certain strike price.
Yep.
In the future at a certain time or date, right?
Right. So if let's say I'm going to keep math easy, not Tesla price. So let's say I think the stock that I'm looking at is maybe it's trading at $10.
$10, okay?
Okay, and I look at it and say, wow, that's $10 is a good price, but I think in the next 60 days it will go to 20.
Double.
Yeah.
Okay.
So that's why you look at it and say, I think it's going to go up, right?
Okay.
So I might look at that and say, I think it's going to go up to 20. So I might pick something, in the middle of that or just below 20 and say, maybe I'll say that's going to be 18 just to play safe.
Okay.
And so I'll call that strike, but then I'll go to the big old option chain list, find something that's about 60 days out. And then when I say 60 days, that's it'll my contract to control those shares expires in 60 days.
Okay. So before you go further on that, let's understand you're buying at a certain price, this contract, that company right now is $10 a share. You're buying a contract that says you have the right to 100 shares of that stock at $18 a share, and that contract expires in 60 days from there.
Right.
Okay, all right. And so then that means that in those 60 days, do you actually get those 100 shares or do you sell that contract? What do you do?
That's the option, right? The option is that you get to buy them.
Yeah.
But math has to work. Otherwise, it doesn't make sense to exercise that contract.
Right. Okay. So if the stock were to go to $30 in 30 days, your $18 option would be worth some pretty serious money.
Yeah.
And you could decide to buy 100 shares of that at $18 a share, and then you'd have the shares at $18 and the stock is at $30, and that's called executing that option. But normally people just buy and sell.
Yeah, because one of the cool things about options that I like is if it's like trading at 10 today, and I buy something at $18 for down that has a long expiration, the value of what I bought as it starts to approach that $18, the value of my contract starts to increase.
Go up.
Yeah.
Right.
So I don't necessarily have to wait till it hits 18.
Right.
Because someone else is saying, hey, it's not gonna hit 18, it's gonna hit 50, and so that price that you paid, I'll take that.
That's right. Yeah.
So.
And that is the key thing on options. Most of the time when you are buying and selling buying a call, or we're going to talk about a put in a second, but when you're buying it, you're likely going to just trade the contract, trade the option. You're not really going to execute it. Most of the time, it doesn't get executed. Now, we're just talking about simple. The options can be incredibly complex, and I trade options every day, and I don't go into a lot of the different complex option trades. I do mostly directional, so I'll go up or I'll go down. But what is a down? I mean, you said earlier.
Yeah, I said I without knowing it right out in my language, I actually said the other term, but it's a put.
A put. Yeah. So a call is looking at it to go up, and a put is looking at it to go down.
Yeah. So and it's really a simple way is you're betting that the value is going to go down.
Okay, so let's use that same $10, and you're buying in the future. A put option for say $4 or.
Yeah, if I'm looking at a stock and I know, or I believe, I should say, that company or that industry or that segment, whatever indication, I believe that they're going to have some hardship coming.
Okay.
Right. So, like the airlines.
Yeah.
The airlines, they were doing fantastic up till this COVID pandemic thing hit in March.
Right.
Everybody was doing fantastic. A lot of companies have come back, but the airlines are still
really
kind of
struggling.
Yeah, they've come back a little bit, but they're struggling. I think the oil industry is similar, right? So here's the airline industry. They're climbing on their stock value. Pandemic hits, everybody goes down this way, and then everyone kind of hovers down at a certain level in March. and some companies go up, but others just kind of hang out there. Well, the airline industry, they get, we go into another lockdown, right? And that's what happened. And we went into the lockdown, their stock went down because when they were all getting excited that we were going to start opening things up, that the pandemic was going to start to be
Get
less
better,
and less.
right?
Yeah,
More people are going to fill airplanes.
yeah,
and all.
they're going to start traveling more, right? So the airline stock started to decline, but then you guys like, I think there's going to be another lockdown. Well, you could put a put on that, betting that the airline value is going to drop.
Be a good time to do it, right? The minute you heard something, if you could beat that. So,
that's the hard part, right? Is
Right.
the minute you hear something on the news, it's probably
too late. Yeah, they say buy on rumors, sell on news. So, so let's look at that though. To get a put on something like that, with that same example of a $10 price of the stock, when the stock is at $10, you buy a put at say $4 that's 60 days out, and you're betting that that stock is going to go near or beyond go down on that $4. So if it gets to $5 from 10 down to $6 or $5, you're making money on that put.
Right.
Okay, great. So they work both ways. So if the stock goes shooting up and the stock goes shooting down, you can make money. And the truth is, you can also make money on the sideways moves, but those are quite a bit. Those spreads and things are
the
credit spreads and lots of things are a little bit complicated.
It's a combination of using
Puts and
calls, sells and buys.
Yeah.
Even some margin type scenarios, and you're basically buying with credit and margins. And
right, because we've been talking about buying a call and buying a put, which gives you the right, not the obligation, to execute that, to own those shares. The challenge is somebody on the other side of that is actually selling that to you. Theirs isn't a right, there's an obligation. They actually have to have the underlying shares, because if you call it in, they need to do it.
Yep.
So there's a whole, options can be complicated.
That's when the complications come in, and it's also where the risks,
it is.
A lot of risks come in, because when we're just doing the buy, the call, or the buy, the put, our risk is only limited to what we purchased.
Right.
So if we spend $500 to buy a call, our risk is that $500.
Exactly.
Where if you get into some of the other complicated stuff,
where you're selling something, it can go to infinite loss.
There's some big dangers there, and that's where a lot of people get into trouble.
Yeah, absolutely.
So
and I want to make a point here. Some of you folks out there that are trading on like Robinhood and stuff, you got to be very careful, because a lot of the exchanges will say, okay, you got to go through a process to decide what level of options tradings you can do, and they won't let you get into some of those bad things. But some of these newer platforms, they say, hey, it's free world. You want to do it, go and do it. And you could get yourself in a lot of trouble.
Yeah.
So don't just go into this lackadaisically.
Well, highly recommend that, and I think Warren Buffett says you shouldn't be investing in something you don't know, right?
That's exactly
So highly
right.
recommend that if you're interested in learning about options, which is a fantastic way to get into the market and make some decent money with very low risk.
If you do it right.
You got to do it right.
Right.
Right. Like if you real estate, you got to have some really good knowledge to be able to do it with almost nothing. But if you just go into real estate, you're by yourself with just a traditional, I'm going to buy an investment property and park my money there, you're putting a few $1,000s in.
Right.
Where the stocks and stock options, it's a night out on town.
Yeah.
Right.
And I wanted to dig a little deeper into that, because we talk about stocks. So that same $10, let's go to $100, okay? $100 stock. And let's say you really, really like this company and you wanted to invest in this company. Well, if you buy $100 stock and you buy 100 shares of that, that's $1,000, right? Did I do that right?
100 times 100?
That's $1,000, right? But what if you wanted to get 1,000 shares of that? Well, that's going to cost you $10,000. You might not have $10,000 laying around. However, you could buy, well, let's back up. You could buy, so if the 100 shares cost you $1,000 and you wanted to buy an option on that, you could potentially get an option for $100, which controls 100 shares, as compared to $1,000. So
Right.
the idea behind options is you can potentially get into the means of making some money at a much lower price than just straight out buying the stock itself.
Right.
However, there is kind of a corollary to that. Options are considered decaying assets. Why, Steve?
Well, there's two things, right? There is an expiration.
An expiration, right?
Right. So when
Unlike a stock, you buy that 100
Right.
shares of stock and it drops down to 20, it's $100 a share and it drops down to 20, you could wait it out and maybe it goes back up and goes above to 200.
Right, yeah.
As long as you want.
You own that.
Yeah,
Regardless
exactly.
of the value, you own it.
Exactly.
Might not have any value, but you own it.
Right, right.
Where the contract is kind of like a living document where it has a certain time that
Right.
it's born, right? When
We've been talking about
contract-
60 days, right?
We said 60, and then there's stuff that's out there 240 days.
There's stuff that's out there for 10 days. There's stuff that's there for a week, less
Yeah,
than a week.
Yeah. But the part, so that's the expiration. So at the end of that term, 30 days, 60 days, whatever that is, that you either have to execute that option,
right.
And you have to do it before the expiration date.
Right.
You could sell it to get the value out, but if you let it expire, you're done.
You're done.
If there's no value,
There's no
to
money.
the paper anymore.
Exactly.
So that's
Exactly.
definitely. And then there's another piece of options that people need to be aware of, and that is theta.
The Greeks.
And this is where we're getting into some complicated
Yeah.
stuff. But basically what theta, in the way I look at theta, is there is a service fee to hold on to that contract, and it's kind of like a utility fee or a rent fee that the longer you have it, the more you're going to pay in fees. And so if you can do a quick trade, you won't see much of a fee, but if you hold it on, there's a calculation that kicks in that
The fees exceed the value of that option and you lose.
Yeah, and those fees are exponential, right?
Yeah,
That they don't.
yeah.
It's not like you're paying.
They keep growing.
Yeah, you're not paying 1% as you go all the way across. It's that doubling kind of a thing.
Yeah, it goes like this. The curve goes like this as that gets closer to the expiration. A good example in the class that we went to is theta is kind of like an ice cube that you set on your counter, and when you buy that option, the day you buy it, that ice cube is still very cold and hard. But the minute after you buy it, it's been taken out of the freezer and it sits there and it starts melting. And as it warms more and more, it melts faster and faster and faster. And your value melts away like that. So that's why they also call it a decaying asset.
Yeah.
So,
Steve,
but I'll tell you, I love trading options. I mean, it's super cool.
Like 2.5 years ago, what would you say about options?
Yeah, so I wrote that in my book, chapter 10, and I talk about how when I was a kid, I would eat ice cream, and the only ice cream I ever ate was vanilla. And if you ever tried to get me to eat any other ice cream, not a chance, I wasn't going to do it. And then I got introduced to chocolate, what's that Italian ice cream? Oh my Lord, I'm losing my thing. The Italian ice cream. Somebody out there yell it.
Gelato?
Gelato. So that chocolate gelato, and I just fell in love with it. Well, kind of the same thing with options. I used to say, forget it. They're very risky. It's dangerous. I wouldn't trade options. No way. And then I tried it, got kind of introduced to it, and oh my Lord.
Opened up a
whole new world of chocolate gelato options.
You know, stock market's not the only place that has options.
It's true. It isn't.
No.
Give us another one.
Real estate.
Tell me more.
Well, I will. It'll be in the next video. Or not necessarily the next video, but it'll be in a future
Yeah.
video. But I think a challenge that we could have is that we go do an option in real estate this year.
I didn't know this was coming. Deal. Let's do it. Let's do it, and we should talk about that. We should do. You've been jonesing to do a 3-part series on real estate.
I think we're due for.
We
a
need to do
3-part
that,
series
so
on
we'll
real
do that.
estate, so. All right.
All right.
Steve,
Any last things? People, go out and start learning it. There's a great place out there called tastytrade.com, and you can go from the simplest understanding of options to the absolute most complex. Tom Sosnoff is like, while I don't know him, I actually have seen him live in a seminar out in a big city where I went and saw about option. But I read about it. I mean, he is a smart dude, and he really knows what he's talking about with options. And his company, Tasty Trade, and all the people there really know as well. So tastytrade.com is and we don't get paid for any of this either.
No.
I wish we did.
But if you're a little nervous, a little fearful of options, just remember what you want is on the other side of fear.
Yes, it is.
All right, Steve. Great show.
Cheers. Great show. Please subscribe. Tell your friends. Tell your tribe.
Yep. And if you do want coaching around options,
Oh, yeah, we will do that.
reach out to us at coaches@2be.com. What is our thing?
2beexceptional.com. And that's the number 2, B as in Bravo, exceptional.com.
Yep.
Cheers, man.